what's going on here is this is the Bank of England's official rate, and that's where we are at the moment, 2.25%, so 2.25%. And what I'm going to show you here is kind of where markets and traders, people within the market, expected it to go in the coming years. So this is where the expectation was back in February. So, I mean, it's kind of extraordinary, isn't it, to think about how much things have changed since then. Back then, people who were making bets on this stuff only thought that it was going to go up to 1.75%. And inflation was already starting to kind of rear its head at that point. But look at what's happened since then. So what we're looking into the future here. Over the future, what people think is going to happen to interest rates. That was in February. Then it went up to about 2.75 in August. Remember, this is just expectations, but this feeds in to the mortgage costs that we're all paying because it goes into something called swaps rates. You're talking about the kind of costs that mortgage lenders look at when they're working out how to price their mortgages. And then by early September, obviously we had the new Liz Truss government by that point. No one was 100% sure what they were going to do, clearly, as it turned out. But by then, already, the cost of borrowing, in terms of the expectations for where it was going, was up to 4.75% for bank rate next year. So you can see this getting higher and higher and higher, the cost of borrowing going higher, even before the mini-budget. But look at what happened next. So then came the mini-budget, and then last week, that went up to a peak of 6.1%. And I'll show you in a second why that matters so much. The good news is, since then, it has come down a fair bit. Well, I say a fair bit. It's in between the two at the moment. It's about 5.5% is where markets currently expect those rates to go, and that could obviously yo-yo around. But the big difference is really the comparison with where we were only at the start of the year and where we are now. That's a big difference. And when you look and basically look at what's available in the market, you see that that stuff's actually already starting to feed through. So what this is just showing you is, a moment ago, Jane was talking about the kind of average rate that's available on a 2-year fixed-rate mortgage. Well, this is basically it, going all the way back to 2008. And you can see, look, around 2007, 2008, it was up at around 6-7%, so really high in comparison with where it was subsequently. Look, the era of cheap money, cheap mortgages in comparison with much of history. But look at what's happened recently. It was climbing up before this mini-budget, before Liz Truss was elected. It was getting up to around that kind of 4% mark. But look at what happened subsequently. Look at that line. Now up to 6.07%. It's actually climbed a little bit potentially since then. And that is the highest that we've seen since 2008. And here's why that's significant. As Jane was saying a second ago, it's not just about this rate, it's also about other factors. It's about how much debt you have, it's about how high your income is in comparison with your mortgage repayments, and that shows your ability to repay it. That's the important thing. So the chart we really need to look at is not that, it's an affordability chart, and I've got one here, as it so happens, which shows you the mortgage burden. And the higher this line is, basically, the more of your income you're paying on your mortgage each month. This is for new deals, OK? And a couple of things to note here, OK? That was just before the last financial crisis, really getting pretty high there. That was the period in the late 80s, early 90s, before we had an enormous housing crash, negative equity. It was really a really terrible time, probably the most torrid housing crisis we've had in this country. But look here, it was really low recently. You know, we've been living through quite a kind of fortunate time in terms of mortgage payments. But look at what happened subsequently. So before the mini-budget, these rates, in terms of the available rates out there and how much they dig into your income, that had risen to the highest level since 2008. So it was already getting quite high. But then look what happened next, OK? Then came the mini-budget, and that went up to the highest level that we've seen since the early 1990s, late 1980s, up to about 27% of your income. And that's the real concern. It's the fact that we're looking at the burden. Remember, we had similar charts to this when we were looking at energy prices, just how much they were digging into your average income. It's the same thing with mortgages, Jane, and I think that's the issue. You know, we've already been talking about a cost of living crisis for quite some time, but now there's this mortgage element on top of the energy bit, on top of the fact that inflation's really high and that people are quite squeezed at the moment.